Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, we're back, Paul. What is going on, man?
Not much. Well, a lot's going on, I suppose. Still catch people up on the construction loan saga. So I want to give every one of the listeners kind of a what not to do. If you want to get a construction loan and build something someday, you have to put cash where you can get at it. So what we've run into, Dave, is initially we thought our qualified plan money could count as a reserve. And then they said, well, it's not really liquid because they have these rules in place. Can you send us the rules? In my case, it's for the TSP. So I send them the rules. They're like, yeah, you can't really do any of these things. And so that can't count as a reserve. So the, money you've piled in there is worthless. And we have some friends that have run into this as well because they're doing kind of the same thing.
Interesting.
So if I could pass along the lesson, put your money where you can get at it, especially you young people. And I'm not talking necessarily about the match, or if you're an employer match, or the airline puts, if there's an employer like an airline that puts all the money in a 401k for you, fine. That's fine.
Yeah. But realize you're not going to be able to use that as
That's
cash
right.
reserves when you go apply for a loan.
Nope.
Yeah.
Now, the truth is there are ways to get at the TSP money. You just have to prove certain things or if you don't have to really prove it. But you have to say, I have negative cash flow or, other ways. So,
Yeah.
But lesson learned, man. I mean, we don't know. But if I go back 20 years, I wish all that money was life insurance cash value because I wouldn't have had to do that public service announcement just now. So,
Well, all net worth is not created equal,
that's right.
right?
Cash is king.
Cash is king, and cash that you can access is king of all, right?
It sure is.
Without
yeah.
penalty.
So we're going to be okay. We're going to do some things, and so we'll be all right. But
Well, some people who can give you a loan to fill the bank.
yeah, imagine that.
Yeah. So,
But anyway, it's so frustrating, right? It's unbelievable.
yeah. The saga continues. So this is good, man. We're all learning from the pain you're going through. So thanks for sharing.
Yeah.
It was good to see you last week. So I was in
That's right.
Virginia for a full week doing some, the National Convention Center should be called the National Confinement Center. It's like a concrete labyrinth. Feels like a white collar prison. That's the only thing I can compare it to. I've never been to a white collar prison, but this is probably what it's like.
Yeah.
Like a tiny little dorm room. It's just garbage. The food was good, but got to see you. That was cool.
Yep.
Thanks for you and Tammy and the kids drove up and went out to dinner. That was nice.
Yeah, it was.
Yeah, that was like the only time all week I stepped outside.
Yeah, it was pretty miserable. It was bad. We
It
had
was
the
raining
snow
a
on the
lot.
ground, and it was
Yeah.
cold. So
Yeah.
Yeah.
But I'm heading to Florida here shortly. So going down to Marathon, Florida to meet with some business partners, talk business, and in a nice warm climate.
excellent.
So that'll make up for it. Yeah.
Nice.
Yeah, man. So, all right. So today we're talking, and we want to get back to the basics on a few things. I think a lot of times when we talk on here, we're talking to our audience, who we consider to be, weekly listeners, right? Or even clients, or people who understand infinite banking to a certain degree. Sometimes we need to step back and talk to people as if this is the first time they've heard about this, or they've been listening, but they're not policyholders yet. They're not controlling their own capital yet.
Sure.
So one thing that's come up lately with conversations we've had is, people might listen to the podcast and hear that, Dave owns 11 policies and Paul owns how many, 10 policies or whatever that number is at this point. They own a lot of policies. And then we get on the phone with prospects who have listened to the podcast and they say, well, should I open, like 3 or 4 policies right away? And that's when we realized we need to take a step back here. So we talked about how many policies we own. Paul, why do you own so many policies?
Yes. Well, so really simple. My journey was I started with 4. I opened up one on me, one on Tammy, and then one on each of our children.
And why'd you decide to start with 4 instead of just one on you?
That's a good question. Well, Tammy and I are both breadwinners, so we, basically have the same income. Although she got promoted to colonel today, so.
Oh yeah, congrats, Tammy.
Yeah,
Paul has called you ma'am.
That's right. No, she's done very well. Very proud. But yeah, so we both needed our insurance, and we both owned whole life. We've talked about it in our previous episodes. We had whole life through another company or a couple other companies, and we've had it in our entire military careers. So we moved the cash value from those policies over and jump started our 2 policies, and then had some smaller policies opened on the kids, because I was like, let's get them started. Let's lock in their insurability, their ability to pay premium at a young age. So God forbid something happens, they've got that ability to pay premium, and they've got a significant amount of death benefit, more than most adults do that are serving in the military right now, actually. So that was my personal story. That's why we started with those 4, and we went from 10 to 4. So we had 10 whole life that were just vanilla, no dividends, low premium, and we changed over to dividend paying, and so
okay.
that was our story.
There you go. So you
4.
stated a really good reason right there on getting policies for the kids right away, to lock in their insurability, to ensure that they have permanent life insurance coverage for the rest of their lives, no matter what happens. Because the sad truth is, we could become disabled or sick or uninsurable at any given moment, really. Right? Yep. Life is unpredictable. The future's unknown.
Yep.
So that's a great thing. So you could have done, like, let's say you take this premium that you wanted to pay and you spread it over 4 people. You could have done that just over 2 people, like you and Tammy, or you could have done it all on one person, say maybe you or Tammy, one of you,
correct.
But you were both breadwinners. You're both making the same amount of money. It just so happened, which is pretty rare, but you had the same jobs essentially. Right. So it made sense to get both of you insured at the same time. A big question that comes our way is, somebody says, well, yeah, I've got a wife, I've got 2 kids. How many policies should I start with? Here's the amount of premium I think I want to pay. How do we spread that amongst the members of the family, or do we just pile it all on me, the breadwinner?
Right.
Yeah. So, how do you handle that conversation?
So normally, if I have a family that's got one breadwinner, let's say, which is often the case, sometimes it's not, but often it's the case, the primary breadwinner, and that's typically the husband, needs to have the majority of the available premium dollars paid on his life, assuming he's insurable. Let's just assume he's insurable and everything is going to be hunky-dory. However, he needs to consider that what does his home life look like if something were to happen to his non-working, let's say, housewife that takes care of the kids, runs the household, and whatever else, right? That has tremendous value, as we all know, right? Mm-hmm. Shuffling the kids around, doing, keeping things in check, and the school and all those things has tremendous value. He loses that value, which would be extremely expensive to hire out. Like, a nanny's expensive. Around here, you're talking $6,000 to $8,000 a month where I live.
Right.
Like,
so that's
big bucks.
Yeah. So what would be the financial impact, right? If
exactly.
something happened to mom, and that's huge, and not only the financial impact, but the emotional impact.
Oh, sure.
So are you going to want to, get up and go to work the next Monday after you had a weekend to mourn with your kids, and then Monday, I got to pay the bills. We got to keep the lights on. I need to go to work and leave the kids home with who, you
Right.
know? So yeah, that's, I'm such a huge proponent of that, telling people, hey, if your breadwinner spouse doesn't have life insurance, you need to make that happen.
Yeah. And let's say there's not quite enough premium dollars to go around to where a whole life policy, might make sense. You can do what we always talk about. You could do a convertible term policy
Yep.
to at least cover that gap until there's more premium dollars available because we've gotten a raise or we get a better job or whatever, or maybe she goes back to work after the kids are in school, or something, whatever. Once there's more premium dollars, then we can start to kind of convert some of that convertible term insurance into a whole life policy or series of policies on her as well.
Right.
So,
And if you want to get policies on the kids, both parents are going to need to have life insurance. So just keep
Right.
that in mind too, and assuming they're both insurable.
Correct.
If one parent, if you're uninsurable, then there's exceptions that can be made. They're not going to deny
Right.
life insurance on your kid because you're not healthy enough for life insurance.
Right.
But yeah, you need both parents to have insurance before the kids can get insurance.
That's right.
So keep that in mind. But I think the convertible term, that's a no-brainer.
Everybody should have it.
Yeah.
I'm convinced of that. I mean, if buy term and invest the difference is like a strategy for everybody in America and all over the planet, I would one up it and say, yeah, convertible term.
Yeah. Buy a convertible term. Yeah.
And if a couple episodes back, I told that story about an old Army buddy that did not have convertible term and then ran into some health issues and now, finds himself in an uninsurable status. So
Yeah.
it does happen.
Yeah. It
More
happens.
than you know.
Everybody can probably name somebody
Sure.
close to them who's come down with cancer at an age well below 80 years old. I think most people die of cancer, but that's when they're already close to mortality anyway.
Yeah. My best friend from my elementary school years, we were in our early 30s, and he was like, man, what is wrong? Turns out he had leukemia.
Yeah. My best friend's mom died of leukemia when we were in 6th grade.
Mm-hmm.
So, so she was probably 33, 34, maybe. Yeah. So it happens. I mean, it's unfortunate. I hate talking about that, but
Yep.
you can't avoid it. So when people hear, oh, you got 10 or 11 policies, why in the world would you start another one? You got 4 policies, you got your banking
Right.
system set up. You're fully funding them. You're taking loans, you're repaying the loans, and you're maxing them out every year. Why in the world would you need more policies?
Well, maybe you've become more productive and more successful and made more money, right? Let's say you were making $100,000 a year and then you opened up some policies of what you could afford. Let's say that was 15, 20 grand a year premium. And then a few years later, you find yourself making 150,000.
Yeah.
And
Right.
now it seems like all things being equal, right? No lifestyle creep or unexpected things, right? You could pay more. You should be endeavoring to pay additional premium.
Absolutely. At least some percentage of that. I mean, if you got a policy 5 years ago and you haven't reevaluated getting another one now, either one, you're not making any more money than you were at that point, or two, you just haven't thought about it because you haven't made this a foundational part of your life.
Right.
Like-
I think, yes, that's exactly right. It's actually just a lack of understanding. Like our mindset is, and people who truly understand the essence of what we're doing here, we're always, you want to pay more premium. Like I wish I could pay 7 figures a year of life insurance premium. And
Mhm.
some people do. We know people that do. I'd love to be at that level.
Yeah, I hope to someday.
Right? Exactly. So, but we're always endeavoring to pay more premium. Not making ourselves premium poor. That's not what we're talking about. We've mentioned that
Right.
before on the podcast, but when it makes sense. So if I got a, $100,000, if I changed jobs and now I'm making twice what I was making before, and it's 5 years in, let's say, or 10 years in, okay, now I can dedicate some of that pay raise, a significant chunk of it probably, to premium.
Yeah.
And I should.
And you should, right? Because there's a reason you did it in the first place. So just continue along that mindset and stay in. A lot of times it's easy to do something And then, okay, I've done that. I'm going to set it aside. Yep, I pay that bill every year or that premium every year. Um, but you kind of forget why you did that in the first place, and you forget all the possibilities you have. And now you got more money coming in, and there you go back to saving it in somebody else's bank. It's like you've forgotten what you learned earlier. You just need to relearn it.
IBC amnesia.
IBC amnesia, which we did an episode about not too long ago.
We did. I don't think you can ever truly outrun your need for finance. You're always going to have a need to finance something, especially as we age, especially when you look at what, long-term care facility costs, or just, it's, things are outrageous, or just what are your plans for retirement income?
Yeah.
Have you factored in taxes from that traditional 401k or traditional IRA that you set up that everyone told you that was like the greatest thing you should be doing, right? Because it gives you a tax deduction now. It gives you a tax deferral.
So I don't know how many people you talked to lately, but I've talked to so many people lately who they contact me because they were talking to their parents or their in-laws who are at retirement age, and their financial advisor saying, "Hey, I think you need to delay retirement for another 5 years, maybe more."
What an awful
thing to get to that point in life and then just get kicked in the gut and say, "No, head back out there for 5 more years and then think about it."
Yeah, I walk around the building, and I see people. I mean, there's people in their 70s in there. There's people definitely in their 60s for sure. A bunch, a ton. And
it's not because they don't make good money.
Oh no, people come here because they
make good money.
Yeah, I mean, if you're I don't know if you're a GS13 or 14 around in this area, you're probably pulling in between 120 and 140, 150 probably, I think.
Right. So it's not for a lack of making a solid income. It's for a lack of controlling your capital.
That's right.
The banking process is going on all around you. It's your choice whether to be involved or not. That's what it comes down to.
And you have not spent the time to recapture interest you've otherwise lost to the third party lender your entire adult life, which is 34.5 cents roughly out of every disposable dollar. So it's a lot of money.
Yeah. Show is. There's another episode we'll put in the show notes. Episode 33 discusses when to start another policy. So a lot of opportunities on when you can start another policy. So we didn't start our banking system with 10 policies right away, right? Mine started with 3, Paul started with 4, and then I just added 1 every couple of years. Is really how it happened. As it made sense financially, a natural expansion. I didn't force it, didn't overextend myself, but I didn't underdo it either. I think I did a comfortable, the right amount, and and if things go as they should, you should be making more money this year than you did 2 or 3 years ago. Right now, the last few years have been kind of weird, so it's understandable people taking a hit.
Right.
Yeah.
The value of the dollar might be not as good, but you should have more of them coming in.
You should have more of them.
They're just worth less. So
yeah.
Sorry.
Did you say worthless or worthless?
Both.
Yeah. Exactly.
Yeah.
All right. Well, so hopefully that helps. And again, episode 33, go check that one out. But we're also, before we hit record here, we were talking about what type of policy, because there's some confusion too. And I like these kind of questions when people are confused about what Nelson said in the book, because that means they read the book and they put some thought into it. Right. So, we came upon page 38 in Becoming Your Own Banker, where it talks about, what's the right type of policy for the purposes of infinite banking. And there's some confusion there. So I'll let you expand on that.
Yeah. So I think, and we've had probably hundreds of discussions with people over the years now about things that are said in the book that are taken as gospel, and they should be taken as, hey, that was just Nelson showing you that particular example, or showing you a way that you could take the dividend in cash, or but he says in the addendum that he would use loans, right? So there's a lot of things that people just, they see it and they don't read on maybe, and or they forget what he says, or something happens.
Or they highlight it, and then you don't see what's following that when Nelson starts talking.
That's right. So on page 38, there's that like line, that a chart, I guess. On the left side of the chart, it's the single premium policy, which would be a mech, and then he's got like a vertical bar that shows the kind of the mech line, and then a 20 pay, life paid up at 65, ordinary life, which would be, let's say, paid at 100 or paid at 121 or whatever.
Yeah.
And then you have on the far right term insurance, which has no cash value, right? No future value, technically.
Unless you die on time.
Unless you die on time, right?
Yeah, which would have to be early.
So I've got some underlines here, and I can't tell you when. I don't date when I underline this, but I have on the left side in the second paragraph, I have the shorter the payment period, the better suited it is for the purposes of the infinite banking concept. Now, there's this whole group of people out there, and, not bad people, but that doesn't mean that I should have, like, one of the illustrations in the book, I think, shows a guy paying premium for 4 years, and then nothing, and then the dividend's paying for everything, and he's doing all this stuff, or there's a 20 pay in there. Those are just those specific examples.
The examples. They were not Nelson telling you what to do. He's saying this is what you can do.
What you could do.
The banker can do whatever he wants, right?
Right. So I'm 44, you're 44. What works for us right now may not work for somebody who's discovering IBC and they're 65 years old, or 62 years old, or 58 years old, or someone who's 25, right? There's going to be different considerations. And we were talking, I think you put this perfectly, Dave, is the best policy for you is the best policy that will accept the amount of premium that you would like to pay for as long as possible.
Exactly.
Did I say that clearly? I hope I did.
Yeah, the best policy is the one that allows you to pay premium for as long as possible.
Right.
So what is that typically? Age 95, age 100? I mean, that's how we design the policies for our clients, is you have the contractual right to pay that premium for as long as possible. Now, just because you have the right to do it, does that mean you have to do it?
You don't have the obligation,
right.
But I want the ability to pay that premium as long as possible. And I'm going to pay the premium. I tell all my clients this till I graduate, right? But again, especially as the policy gets older and older and older, very few things get better with age, right? There's some alcoholic beverages that do, but very few things get better with age, right?
Yeah.
These do. So later in life, you're going to have the ability to make informed choices of how that premium gets delivered to the company. Oh, I had a bad year. I thought I was going to, I thought my 401k was going to pay me this much. I could only take out this much because of the market downturn. So I've got to use part of the dividend to pay some of the premium, whatever.
Mm-hmm.
But you're going to have those options if you've properly capitalized the policy. And unfortunately, there's a lot of people out there that are just, in my opinion, they're just not doing it the right way. And that's fine. They're doing it the way they want to do it. Fine. It's not the way I'm doing it. It's not the way you're doing it, but.
Right. And, there's more on that. A big question is, well, how do I fund this in retirement? Well, check out episode 32. How can I continue funding my premiums when I retire? You have so many different options, but the greatest option that you maintain is the ability to pay a premium. Because guess what happens when you've owned that policy for 20, 30 years, and you're paying a premium at age, say 65, that random arbitrary age, and you've had that policy since you were 40, well, guess what? That premium, you every dollar you pay in premium, you're probably going to get somewhere around $4 or $5 in cash value for it. So, Paul, if you could give me $1 and I give you back $5, when are you going to want to stop giving me $1?
I would never stop doing that.
And that's exactly how it works. The older you get, the more efficient the policy gets. And it's the absolute first place you want to put any of your retirement income before you spend it, because you're creating a multiplying effect.
That's right.
On
It's
that
a multiplying effect. That's right.
on that money. Like,
That's right.
that'd be, how amazing would that be to have that opportunity to amplify and multiply your retirement income, because you've had this thing that you've built all these years and you've been using it all these years as well. But now it's at the point where, man, that $100,000 a year I take in income from my 401k, I run that through my policy, assuming you had $100,000 in premium you could pay. You probably don't, but maybe
Man, if you could,
maybe you got
think about
20
that.
grand. Yeah, maybe you got 20 grand. So the first 20 grand you get that year, oh, you're paying your premium, and all of a sudden, bam, that's now 100 grand of cash that you
Right.
just added to your cash value. So
That's right.
that's an example. Every case is different, obviously.
Right.
But that's a pretty solid example that I've seen time and time and time again.
Yep. And it's, you know, we might not be getting better with age. I mean, some of us are, but your policy will, and
I'm still in my prime.
that's right. Yeah,
Doc
you
Holliday.
look it. See?
Yeah.
Yeah, you look it. But
Touche.
But how nice is that? You know, there's enough crap to worry about in life that you're going to have this reliable asset that is really just uber efficient, where every dollar and later in the policy's life, which is also later in your life, is producing $3, $4, $5 of premium, depending on when you started the policy. So our children's policies, I mean, they're just incredibly efficient by the time they're going to be our age and beyond. I mean, just amazing, and reliable, and
Yeah.
that's nice.
Well, and for all my clients listening right now, I keep notes on all of you, and I keep notes on how much we applied for, as far as the premium goes. And so when you email me or you call me or I don't know what kind of communication abilities we'll have 20, 30 years from now, but 30 years from now, when you get a hold of me and say, why didn't you make me pay more premium? I'm going to send you a copy of the notes and say, I tried to, but
Yeah,
you
you
didn't
whipped
listen.
out.
Yeah.
Yeah, that's right. And we've had the discussion about my first 4 policies. I wish
Yeah.
I had made the first 2, probably not on the kids. I don't want to max out their human life value at such a young age, but on Tammy and me, I wish I had made those premiums, you know, maybe twice or 3 times as large if I could have.
Sure.
And I could have made them bigger, but those are efficient, right? I'm going to make the 6th premium on those this year. So this spring,
Nice.
the 6th premium will be paid into those. And, you know, I'll just say it, right? One of the policies is like $15,000, and I think the cash value is expected to go up by about 19
Nice.
or 20.
Already in year 6. That's
in year
awesome.
6.
Yeah.
And so very happy. Yeah, very, 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 very happy.
Yeah. Good. So if you can sacrifice in the first few years and have that long-term mindset, you think long-term, right?
Yeah.
That's all it takes. And time goes pretty darn fast.
Yeah, I gotta say though, I don't think I sacrificed anything.
Really. Yeah.
No, I haven't sacrificed anything, because doing that and putting that money where I could get at it is enabling to do things that people I know aren't able to do, even though I've been barking at them for a couple of years now. Like, hey,
Yeah.
this is what we're doing. Here's where I'm doing it. It's not as bad as these yahoos on YouTube or whatever say. In fact, it's pretty awesome. Read this book, and you know, hey,
Yeah. Yeah. Thanks for correcting me. You're right. I mean, it's not a sacrifice because you're not going without. You know,
No.
usually a sacrifice, you have to go without. You're
Right.
not really going without. You're going without 100% liquidity for a few years, right?
right. Well,
But if you can do that, I mean,
So-
you're guaranteed to win.
yeah. So in my case, I took money. Well, after the fact, about a year into it, I stopped the TSP. Right, I stopped contributing to the TSP. I haven't contributed since 2020. So that was money I'm locking up anyway. So I've gained liquidity by redirecting money I otherwise was putting in prison till I was
Absolutely.
59 and a half, which I'm now hurting now for, right? And there's a
Yeah.
ton in there. But I redirected those funds to where I could get it, and that really helped see other opportunities, build the house of our dreams, whatever.
Yeah.
And so I'm thankful for that. But
I just gotta say, what the TSP is such a joke. Like, what
I would say, as 401ks go, it's very good.
Well, but you don't get a match, right?
There's no match.
There's no match
for the civilian employees. There is, but not for us.
but not for military. So you get no.
But we
match.
get a 50% retirement at 20 years. Like,
Yeah.
you know.
But you get no match. You get
Right.
it. You get the tax deduction, right?
Yes.
I
if
mean,
you're
the
in
tax
traditional-
deferral. But
Yeah.
the fact is, you don't pay much taxes when you're in the military anyway.
That's
Why are
right.
you trying to go get a measly tax deduction on that
Right.
amount? Like, it just blows my mind. Like,
Yep.
there's no point.
You're already getting a tax deduction because your housing allowance is not taxed.
Right. You'll hardly pay anything in taxes as
Which
a military.
around
member.
here is like almost a third of my income.
Right. Yeah.
So
So-
actually it is. It's more than a third.
Yeah. So
So-
put your money where you can access
can't-
it. Because guess what? Everybody's going to get out of the military at some point. You're going to retire at
Yep.
some point. Having access to capital without penalty would be pretty nice to have.
Yeah, it's yeah. I wish
Yeah.
I had double that what I have right now. In a few years I will, but gosh, I need it right now. So timing is everything, and just learn from my lesson, folks. It's
Yeah.
you're gonna more doors will open because you put your money where you can get at it.
Yeah.
It's as simple as that. It's true.
You just
100% true.
need a little discipline not to spend it like it's a piggy bank. Right. That's it.
Right. That's right.
So, well, cool. And I think we covered some good stuff. So check out episodes 32 and 33 that we referenced here for more info on this kind of stuff. But
Yep. And reread page 38.
and reread it. Yeah. Eyes open, read the whole page. Don't just glean to one thing.
We just glazed over it, but there's some very important things that he says there. And he qualifies what he says. He doesn't say get a 10 pay. He doesn't say pay premium for 7 years and then do RPU. He doesn't say any of that.
No.
He never says that. He never talks about the internal rate of return of the policy, as far as I know, either.
No, if you ever have just 5 minutes free and you pick up the book, just read pages 3 and 4. Just read the introduction.
Yep.
Read that over and over. You'll be far ahead.
Yep.
All right. Well, good episode. Have a good week, everybody, and we'll see you back here next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.